Good morning, everybody. It's Wednesday, December 18th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here at March corn unchanged at 443.5. March soybeans were down 13.75 at 965, and March Chicago wheat was up 2.25 at 547.25. This morning, we had a couple of export sales announcements from the USDA, 135,000 metric tons of corn to Colombia. That's for 24. Also to Colombia, 120,000 metric tons of soybean meal. That's also for 24. Guys, we're going to have the Fed decision here today. It looks like near certainty that you're going to get a quarter-point cut. So we'll be looking at that here later this afternoon. A lot of news, on Capitol Hill. Looks like they're going to get the stopgap funding bill through. They're supposed to vote tomorrow night. Farm Act was certainly a big part of that for the ag sector. Section 2102, if you've got some time to read today, that's where it's at in the bill. And I know we'll have some breakdown of that and some more details as we go through it here today in our evening commentaries. But Dustin, looks like we're kind of breaking through some technical levels here in soybeans. It was pretty poor performance overnight. Maybe a few thoughts here as we kick off the day, and then we'll throw it around the room.
Yeah, new lows for the move, so I think that's part of the acceleration down. We're still finding extreme weakness in the Brazilian real as well. So we kind of talked about this in the letter last night, but, since the beginning of October, the real is down over 10%, just right around 11%. And NOV 25 beans are down 10.9%. It's not a coincidence. In real, beans literally are not moving through that dollar break that we've had. And, by all accounts, we have the weather to support it down in South America. Good rains forecast, huge acreage. So I don't think the world's concerned about bean acres. It should be concerned about corn acres, as I don't want to be a broken record, continue to talk about, global stocks outside of China, but they are very, very tight for corn and wheat. And that's what the world needs the U.S. to produce next year, and it's trying to incentivize that through the ratio. New lows in the ratio yesterday and overnight, and that's the ratio meaning NOV 25 beans divided by DEES 25 corn. But, as Justin's mentioned as well a number of times, that ratio needs to get extremely low when both products are in the negative to convince those corn acres, because, you're talking about, $100 plus an acre loss projected. There is still an appeal, maybe not necessarily in Illinois and Iowa, but definitely outside of those areas to try to, plant the lower cost crop if there's not a slam dunk corn on corn rotation. And so this is where, I think a lot of people have been expecting corn acres to rise again, coming out of kind of a heavier bean acreage number in 2024. And I still think that that's going to be a potentially hard thing to do when you're so far below break evens right now for both products. So there's just a little bit of my opinion. We'll find out more as we get through the Feb outlook and those March planting intentions numbers. Could be very wrong on this too, but the ratio is trying to do the work right now.
Yeah, Justin, it's going to be interesting to see, with this, early numbers that we were looking at this morning for the Farm Act. I mean, it's around a $50 or so payment on corn. You've got, an approval for year-round nationwide sales of E15. Just a lot of things kind of thrown at the corn market this morning. What are your opinions just on the outside looking in?
Yeah, I mean, we talked about some of it yesterday. It's just, we've become so dependent on government policy and subsidies, and I think it's really hurt our market. We're trying to build this domestic demand base, and we still let Brazilian ethanol come in and use cooking oil from China and all these other players. And so we go past E15, like, why not fix the issues that we do have? It's just like we just keep throwing more stuff at it and then letting loopholes exist. So it's just, this is part of the whole government efficiency issue in general. And ag's no different, so we're trying to do these good things where, we invest billions of dollars, find ways to use our products, but then we don't regulate it correctly, or we just, skirt around it with direct payments. So there's a lot of mess here, and $50 an acre payment isn't going to fix in my opinion, the corn bean problem. To Dustin's earlier point, it's unfortunate that we're trying to gain corn acres by, beating up bean prices. So really the market's more concerned about, not losing enough bean acres, I think, with the good weather in South America and the, large carryout we have here. So usually you like to have the old acreage battle, right, where you're trying to get enough acres of one or the other, and it's done by a rallying market. And unfortunately, we're doing it right now by a breaking bean market. So not the funnest way to have an acreage battle, that's for sure.
Yeah, right. Ben, what's on your mind this morning?
Yeah, I think Justin does a great job of articulating that right now it's a lesser of evils acreage outlook, and that's not fun for anyone. I do think, we were kind of talking before the show. I think you look at soybeans, and Dustin brings up the point that beans have kept up with the currency on the decline, and I asked myself, looking at not a humongous short in the beans, not even close to being record. Is this just purely South American selling? And do we set up at some point in the future to, if things were to go bad, to really get maybe a hyperbolic move? And there is a long way to go to finish up the crop. It's been perfect to now. It may finish perfect, but we saw this in 16 where the market had to turn on itself and everyone has to buy back hedges, and it can get really sloppy and messy for a while. And when you're talking about sub 10, potentially looking at the chart, maybe mid to low 9 beans, it starts to have a little bit of a, I think, lack of risk in there to account for the things that can potentially go wrong in the last 2 or 3 months of bean production. So I think Dustin mentioned actually last night or the night before in the commentary about this, like there's ways to address that if that's something you're concerned with. And it certainly feels like, you look at the volumes and the path of least resistance is down, and people will stay with that until they don't.
Yeah. Dustin, quickly, like I mentioned earlier, we're going to get a Fed decision today, by all accounts, looking for like a 1/4 point reduction in rates. But the big key will be the dot plot, as always, to see what their forward guidance looks like. Maybe a couple of thoughts on the outsides there.
Yeah. So, since we've endeavored down that rate cutting, for the nearby, for the benchmark rate, we have also found that rates have actually risen at the back end of the market. So I think the Fed's got to be a little bit careful, and they've said this, right? They don't want to, make some of the mistakes they did, last time going, just prior to Volcker taking over, where they cut too soon and too aggressively, and inflation wasn't fully fixed. And I think long-term rates might be showing that in the U.S. That's certainly not in places like China, where their rates are collapsing. The U.S. seems to be like that one shining beacon of a good economy. And if we overdo it, then that long-term rate is telling us a different story. The Fed really doesn't have much control over those long-term rates, and that's kind of markets showing signs that they're concerned. So I would be cautious not to expect an overly dovish dot plot today, and that again is partly why the dollar has still been performing well despite that rate increase.
I was going to say something, just, talking about, not to get back to the real, but, there is a point, and I think we've talked about it before, but where the real gets so bad that it has the opposite effect that it has been having. We saw this with Argentina, where their economy got so bad, similar type policies that Brazil seems to be in favor of, which is hard to believe after you watch what Argentina just turned around. But it set them back decades. We had hyperinflation. Exports stopped flowing out of that country. Innovation stopped. Production went down. People started using, soybeans and corn as a currency. Similar like a Bitcoin, if you think of it, right? That was their hedge against their hyperinflation. And so they would only sell in increments to pay bills, right? It became their currency. So, that is something to look out for. Like right now, Brazil's obviously been expanding rapidly. This devaluation of their currency has been it's been a big windfall for Brazilian farmers, but we could start seeing some of it go the other way. hyperinflation on imported goods and inputs for growing these products, right? So, I think that's something to keep in mind too. We could go through a period where we discount beans or something too much, and it's, maybe start hurting the Brazilian farmer if this continues.
Yeah, and their benchmark rate, the Brazilian Central Bank's benchmark Selic rate is 12.25% right now, right? Ours is mid fours, and we're talking about cutting. They just had a 1 point rise. It surprised the average guess on the economist guess. So they're obviously in a free fall, and things start to break a bit when you have high rates and you have inflation not under control. So yes, they're in our $1 break for beans. Their prices are much more stable. But it doesn't necessarily mean that they're going to be a willing seller at that price too. Like it's how the beans are flowing, of course. Now, the fact that all this was comboed with really good forecast change in Brazil, I think that really kind of supports why we're still able to keep breaking. But eventually, like to Justin's point, it can turn into a tailwind instead of a headwind.
Very good. We got a couple of minutes here, right? I know we got some cattle on feed estimates out. That report's going to be out on Friday afternoon, 2:00 Central. And then again, hogs, it's kind of becoming consistent. We open stronger and then they just continue to fade late into each session. So what are your thoughts as we go through the morning here?
Yeah, on the cattle side, it just seems like the trade wasn't very inspired yesterday. Open interest was up about 839 contracts, but saw kind of choppy two-sided trade. I mean, this market has a long way to go until you actually test some real longer-term support levels. So all eyes are on cash right now. It was a little bit of light live trade in Iowa from what it looks like, and asking price in the South are going to be probably around there, if not maybe a little bit lower. So we'll see how it all shakes up. I think the board's kind of expecting at least steady money here. And overall, the weaker beef prices may just kind of sour a little bit of that expectation in the middle of the week, but we'll see if these packers come after it like they have. On the hog side of things, overall, just still kind of trending lower. Like you said, we just kind of have this little erosion towards the end of the day, and we're using that 50-day moving average as resistance. So we traded right up to it in February and fell right back down. It didn't make a new low for the move. So I think just all eyes are on the cutout, see if that's going to keep on going lower, if cash is going to keep trending lower here. But we've got a massive managed money fund long right now that really doesn't have anywhere to go if things start to go south or continue to go south. So it just feels like that's kind of the bigger downside risk right now, is just if they decide to actually liquidate to a much larger degree. I don't think the market's really that ready for it. So I think it's just a good excuse to keep a little extra protection, and especially ahead of Monday's hog and pig report.
Very good. Appreciate the update. A couple things to note. We'll get export sales tomorrow morning, 7:30 Central. We'll take a look at that and certainly visit about that in the war room. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like or subscribe. Doesn't cost you anything to do so. It'll keep you up to speed on everything AgYield. Again, thanks to everybody that supports the show. We're doing this live every morning that the markets are open, streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.